I'm actually going to record it. I set up the OBS thing that you guys talked about. I got it all set up, and it's actually going to record. I just got to make sure it's
Okay.
recording. I got to make sure it's recording my right screen because I got several monitors. Yes, it is. All right, options. Okay, what are options? Options give you the right but not the obligation to buy or sell the underlying stock that the options trade for. Most companies have options. The garbage companies, the smaller garbage companies that probably don't. Penny stocks don't usually have them. But any company that's of any value has options that trade around it. And it doesn't hurt you guys to learn this stuff because the big institutions and that stuff that's going on in the background, the hedges, a lot of their stuff they're doing with options. So when you see something move or you see a stock move, but you're completely out of the loop on the options, you don't know that they're doing stuff in the options that affect the underlying stock. So you figure it's just moving because it's moving. But they do a lot of their hedging and the betting that they do based on using options on the of an underlying share of a stock, and you guys don't know this unless you learn it. If you guys can learn this stuff, then you can watch what's going on in the background because it's actually a large portion of what happens in the stock market. The options, all options combined, are probably bigger than what's actually going on with the underlying stocks. So by just looking at the stock, you're keeping yourself from seeing what else is going on that's affecting that stock. So tonight, I'm going to start from the beginning. I'm hoping you guys will pick up on this stuff a little bit here. There's um there's four levels that your broker is going to allow for trading options. Okay, they're called tiers. Okay, there's four different tiers. The first tier is what's called writing covered calls. Most brokers will approve you for this level because you in the situation where you're selling covered calls, you own the underlying shares. Okay, options are traded in contracts. Okay, one contract of an option, whether it's a call or put, will give you control of 100 shares of the underlying stock. So if you have one call option on Wish, like I have shown, that option call option is giving you control of 100 of the shares that are underlying on Wish. Okay, so most brokers will approve you for that tier one level because all you're doing is you're selling calls on shares that you already own. And if you're selling shares and it's one contract, you would have to have 100 shares minimum of the underlying stock. So say you wanted to trade covered calls on Wish. And the reason I use Wish because I know Alex is in it and he's got a pretty sizable amount of it. So we can all kind of relate to it because he's in it. And I'm actually in it also in a different way than he is. But what that tier one is going to do, you're going to go to your broker and you're going to say, hey, I want to apply for, and all the brokers will approve you. Well, I say that. I think there's a couple of them like Webull or maybe that don't do options. But you go to them and you want to try to apply as high as you can for the highest level because what they want to do is they want you to build up to that level. They're assuming you don't know what you're doing, so they want you to earn your way to pathway to the level tier three, tier four, and all that stuff. But you want to start off applying really high and let them turn you down. If they say we'll approve you for this, call them up and say hey I need the tier three. And if they say, well, you've already filled out all the paperwork online with your broker, and you send it in, and you said, hey, I filled this out. I told you I got 8 years of experience, or 20 years, or 10 years of experience, and y'all only approve me for tier one. I need tier three. If you call them up, they're probably going to approve you. If they say, well, how much experience do you have? And you say, I put it on the form I filled out. I got 8 years of experience with this stuff. I just changed brokers. So because I changed brokers, I need you guys to approve me to trade options. So basically what they'll do then is they'll upgrade you, even though you don't have any options experience or knowledge. However, you want to be able to have the ability to do some of the things that we talk about in here and some of the things that I'll teach y'all to do. And to do that, you've got to have a higher tier. So you're not going to want to be cleared for tier one and watch us do tier two, tier three stuff where you can't even do it. So right out of the gate, try to go as high as you can. Don't call it lying. If they ask you what experience, what knowledge you have, or what experience you have, tell them I got 20 years. They didn't ask you what you have personally. They asked you what your knowledge is. Well, if you surround yourself with someone like myself or someone else that knows knowledge, you got 20 or 25 years of experience because I have that. So they're not going to get specific on you. So when you apply, you're going to apply for try for tier 3. You probably won't get tier 4, but try for tier 3 minimum, and let them shut you down on that, and then go back to them and try for a higher level and keep trying and keep trying. So what tier 1 is like I said, it's selling covered calls, and I'll show you how that works. Oh, you do have tier 3? Oh, cool, great. So basically, I'll tell you what the levels are, and then I'll show you how they work. So level 2 or tier 2. I hate to say level 2 because people get confused with level 2 on the trading that you guys do. You know what level 2 is, but the tier 2 is where you can buy a call option or you can buy a put option. Unfortunately, the brokers give permission to a lot of traders for that particular tier, that tier 2. It's probably one of the worst ones someone could get approved for because they don't work most of the time, and statistically they're not supposed to work. So why the brokers approve people for that, I'll never understand, because it's kind of a dangerous one. They need to approve their members for tier 3 so that the members can actually make decent trades with options. So if you'll look at what's on my screen here, on the left side over here, all this stuff that I'm circling, I think it shows you guys. Yeah. Can you guys see me moving my mouse?
Yep.
Okay. On the left side here, this is what's called the call side. Okay. On the right side over here, this is what's called the put side. Okay. So on the tier 1, you have the ability to, let's say you own 100 shares of Wish. We'll make it simple and just use 100 shares. Okay. Let's say Alex bought his. He's got 1,650 shares at 11.85 cost. So some of this stuff wouldn't work for him right now, but let's say you bought it today at $9.98. That's what the end of the day at. Okay, what you can do is you can go in here if you own at least 100 shares of that. You can sell a contract. I'm going to go to next week because the weeklies expire tomorrow, so there's not a whole lot of value left in them anymore. So let's say you bought your shares for $9.98 today. Okay, and you bought 100 shares. You now own 100 shares of Wish stock, underlying stock. If you look at where I made the blue line here, if you look at the blue section here, the lighter blue section, there's 3 types of options. There's what you'll see it in. If you're ever in an options room, you're either going to see ATM, ITM, or OTM. Okay, the ATM stands for at the money options. The ITM stands for in the money options, and the OTM stands for out of the money options. Okay, this blue section that's shaded here, it represents the in the money options. So those are money or options that are in the money. The at the money options would be the runs right on the line that I have marked here, which is going to represent options that are trading real close to where the underlying stock itself is trading. And then everything out here that's not shaded on the call side and on the bottom over here on the put side is what's considered out of the money call or options. They have no value. Okay. So if let's say you bought 100 shares of Wish stock today and you bought it at the end of the day at $9.98. If you're approved for a tier 1, if you look at where I marked the line here, it's on the 10 strike. Okay, so on that 10 strike, you can do tier 1, which is selling covered calls. Okay, they're covered because you actually own the underlying stock. Okay, and one thing some people don't understand is with options, it's a little different than what stock trading is because there doesn't have to be someone on the other end to take your trade. Okay, so if you're the buyer, there doesn't have to be a seller. If you're the seller, there doesn't have to be a buyer. Okay, what it is the option exchange comes up with these are all theoretic, mathematical calculated values by a computer. And these values are what the market makers have determined. And they're saying, okay, if you look at this particular one, it shows the bid at 66 cents and the ask at 68 cents. So the market makers are saying, okay, for 68 cents, if you buy that option, that call option, that $10 call option, we'll make sure you're filled. So you don't, the volume on this thing could be 0 for the day, but they will still fill you because they've mathematically calculated that this is where this needs to be for that $10 strike call option. And if somebody's willing to pay that, we will make sure they get filled. So you'll get filled on the ask if you're buying it. So it doesn't have to be someone on the other end. Does that make sense to you? So that changes things a little bit up from what you're used to with stocks. Okay, so in this particular case, can y'all see that this is a 66-cent bid and a 68-cent ask?
Yep.
So basically what you're doing here, if you have your tier 1 approval, you're saying, okay, I'm going to give someone else the right to own my shares. I bought them for $9.98. And for 68 cents, now keep in mind that it's 100 shares, so one contract at 68 cents is going to be $68. Okay, so the 68 cents is times 100, so you got $68. So basically what you're saying is, okay, I am willing to let my 100 shares be taken away from me, whether it's a market maker or whoever it is that takes them, or someone that wants to buy the calls or sell the calls. There will be someone, if there's a lot of volume, there will be someone on the other end, but there doesn't have to be. So you're basically saying, okay, if you will pay me 68 cents or $68 at the end of expiration, which in this particular case is August 13th, which is 8 days. That's 8 days from now. I'm circling it on there. You're saying for the $68, I will let you take my shares away from me. Okay? Does that make sense? Y'all follow me on that?
Yep.
Okay. So, Jerry, does that make sense to you? And Amber? Let's type it in the room if y'all are still here.
Yeah.
Okay.
I'm here.
Okay.
I have to move my car because it's too loud in the coffee shop.
Okay, that's okay. Okay, so okay, good, great. All right, so basically, what's going on here is you bought 100 shares at $9.98. Let's assume you bought them a little cheaper than that. Let's say you bought them today. I didn't see what it traded low at. Say you got them for $9.50. Okay, so let's theoretically say you bought your shares for $9.50, and then you sold next week's expiration 8 days from now. The weeklies are August 13th, and you sold those for the 60. Say you got mid-fill and you got 67 cents for them. Okay, so one of two things is going to happen here. So on expiration next week, okay, on August 13th, 8 days from now, if Wish is trading at 10.01 or above, okay, if it's trading at $10 or above, if it's trading at 10.01, one of two things could happen here. The first thing is they will take your shares away from you because they paid you 67 cents, the midpoint between the bid and the ask. They paid you 67 cents to relinquish your shares, okay? And so they're going to take your shares from you, and if it's trading at $10, you made 50 cents if you bought your shares at $9.50, so there's $50 you made. And then when they take your shares at 67 cents, then that's another $67. So you made, what, $117 by selling the covered calls on the underlying shares that you owe by next week. That's if it's over $10, okay? Let's say you bought your shares at $9.50 today, and next week it closes next Friday at $9.60. Okay, so at $9.60, these $10 strike calls are now what's called out of the money because it did not trade above $10. Remember, we had the in the monies, the out of the monies, and the at the monies. Okay, they will now become what's called out of the money because they're a $10 strike and we're trading at $9.60 next Friday. Those are out of the money because they're below the call price, the strike price of $10. So what will happen is the call premiums that you sold for 67 cents will go to zero, and you can put that in your pocket. Okay? So what that benefits you is you can say, okay, well, I bought my shares for $9.50. It's trading at $9.60, so I'm up 10 cents on my 100 shares, which is $10, and I collected $67 in call premiums. Okay, so now you're up 67 plus 10. So next Friday at a 960 close, you'd be up $77. Okay, the nice part about this is you've now reduced your base cost on those shares by the 67 cents that you collected in premiums. Okay, so if you bought your shares at $9.50, and let's say it stayed below $10, and those will go worthless. You collected 67 cents in premium, and so now that 67 cents comes off your base cost of those shares. So now you're at $9.50 that you bought them for today. You collected and kept the 67 cents, so now you're under $9. So you're in the 885, 890 range. I don't have a calculator, so I'll let you guys do the math. So at the end of next week, if those close under $10, those will expire worthless. And now you've reduced your base cost by picking up 67 cents or $67 per 100 shares that you own. And now you're down in the $8 and something range. Does that make sense to you?
Yep.
Okay. So that's what the tier number 1 is, where you own underlying shares and you sell what's called covered calls because you own the underlying shares, and that's what your goal is. Neither one of those are a bad thing. Number 1, if you sell the premiums and it stays under, you keep that premium. It goes in your pocket. Number 2, if you get the shares called away from you, then that's not necessarily a bad thing either, because not only did you collect the premium up front, but you sold at a strike higher than what you paid for the shares, so it's a win-win both ways. So if it goes up and they get called away, and you bought them at $9.50, they get called at 10, you've made 50 cents on the shares and the 67 cents in premium. Let them get called away. Who cares? You still made money. Okay? The downside to selling covered calls is, let's say the stock takes a big drop. Okay? So what will happen? Let's say it drops $1. Let's say they do earnings. I wouldn't do them through earnings, but let's just say something comes out, some news comes out, and Wish drops $1, and now all of a sudden by next Friday it's at $8.50. Okay, 2 things happen here, or 1 thing happened for sure. We know those calls because if the stock is at $8.50 next week on Friday, we know those calls went worthless because they're definitely out of the money at $8.50 if you had sold a $10 strike. So those will go to zero to whoever bought those calls or the market maker that bought them. So those will go to zero. So that worked at 67 cents in your favor. However, you're down $1 on the stock. So what happens here is you can't, as long as you own underlying shares and you have sold covered calls on them, you cannot put a fixed stop on your underlying shares because you have given someone else the right to take those shares from you, if you remember right. So you were paid 67 cents for someone else to be able to take the share, or a market maker to take those shares from you if they choose to. So you've relinquished your capabilities of doing anything with the stock underneath it as far as a stop goes. You can't put a fixed stop on there and say, well, at $8.50, I'm going to make sure I stop out. The only way you can do that is if you buy those calls back and get yourself out from under the obligation you've given someone else to have those shares. You want to get yourself released from that. So you have to release that obligation first. Then you can put a stop under there. So typically, where do you get in trouble on a covered call situation? For some reason, the stock has a big drop. You had calls sold on it, and you're locked into it because you cannot put a stop underneath there because of the calls. Does that make sense to you?
Yep.
Have I told you anything? You said you have some experience. Have I told you anything you didn't know yet, Razor?
Just about the selling the calls. I never sold my own calls before.
Okay.
I just buy them and wait for it to go above the strike and sell them. Is all I've ever done.
Okay. So we're basically building a circle around tier 1, which is selling covered calls. Okay. We'll go to tier 2. What tier 2 is what Razor was just talking about. If you go to your broker and they approve for tier 2, which isn't hard to get approved for either, unfortunately, it allows you to buy a call or buy a put. Statistically, these options are designed about 95% of the time to go worthless. So if you're the buyer on the buying side, the chances are high that they're going to go worthless on you. So let's say Kyle is the one that owns the 100 shares, and he sells the covered calls on his 100 shares for 67 cents. And let's say Razor is a tier 2 approved option trader, and he can buy calls and he can buy puts. So he happens to be the one that wants to buy those. And I'm building a scenario of 2 people buying and selling to each other when it doesn't work like that. But let's say Kyle or Razor decides, hey, I'm going to buy calls on this thing. Okay, so let's say Razor thinks, I think that thing's going to be higher than $10. It closed at $9.98 today. I think it's going to be higher than $10 next Friday. So I'm willing to pay, this is Razor talking, I'm willing to pay 67 cents for a call premium on a $10 strike for that Wish stock because I think it's going to be above $10 by next Friday. Okay, so what has to happen here? When institutions do this, they say, okay, I want to buy $10 call price stock, call price premiums, because they want to actually own the stock. Where most of us retail traders, we're not always not really trading to own the underlying shares. We're trading to collect the premiums the profits off the premiums. So our goal is not to actually say, okay, I'm going to pay 67 cents so that I can have 100 shares of Wish at $10 next Friday if it's above $10. That's not the retail trader's goal. Okay, but that's how it actually works when you can buy calls and buy puts. So basically, let's say Razor says, I want to buy the calls on the $10 strike for Wish. I'm willing to pay the 67 cents. So the obvious on this thing is it's got to be trading above 1067 for him to even break even by next Friday. Okay, that's the obvious. There's two things that make up an option. Two words I'm going to give you. One of them is called intrinsic value, and the other one is called extrinsic value. Intrinsic value is the true value that the option actually has. And in this case, okay, let me go back up. The extrinsic value is the time value, which I'm going to go into that here in a minute with the theta. It's the time value or the value of the premium that is actually worthless. Okay? So in this particular case, if Razor buys a $10 call for 67 cents and the stock is trading at $9.98, it has 2 cents below the $10, so it has actually zero intrinsic value. Okay? And it has 67 cents of extrinsic value, meaning time value. So basically a $10 strike right at this point with it trading at $9.98, because it's not trading above that $10 strike, has all extrinsic or what's called time value, meaning it's worthless. So it's zero value. Okay? So at 67 cents, that's what he paid. He's hoping that the stock will go up from $10, and I'm going to get into how it will affect the option here in a minute. But that's what he wants to happen. He'd love to see it go to $11. And in theory, if you do simple math, if he's got a $10 call and he paid 67 cents for it, and it goes to $11 and closes at $11 next Friday, he's got a $1 of value that went into the stock underlying, but that also went into $1 represented into the options underlying. So his $10 calls are now worth $11, so they have a $1 value or $100, and he paid $67 for that. So he has 30 something dollars, 33, 34 cents worth of true value, or $34. Does that make sense? Everybody with me still?
Yes, sir.
Okay, so that's what, and I don't want to get into the Greeks yet because I'll throw y'all off. But for simple purpose of understanding it, as a tier 2 trader, you can buy the calls or you can buy the puts. Okay, the put side of all this, I don't want to focus a whole lot on it. Does the exact opposite of what the calls do. Okay, you're saying, okay, if I buy a I'm gonna go over here and circle it. If I buy a $10 put, I think Wish is going to go down $1, and I'm making these as statements. This isn't what I actually think. I'm just making it to make conversation. So if I'm a put buyer and I think, hey, I think Wish is going to go down, so I'm going to buy a $10 put. Okay, the $10 put is 68 cents and 71 cents. So I'm thinking it's going to go down to, say, $9. Okay, so if I decide I want to be on the other side of the table, so I'm going to be a put player, I'm going to sell the $10 strike puts. And if next week, 8 days from now on August 13th, it's trading at $9, then I also have made the same dollar because it's $1 lower than what I sold my $10 strike or bought my $10 strike puts at. And that $1 minus the 60, this one looks like it cost you about 69 cents, is 31 cents profit. So this allows you to play kind of like long stock or short stock. You can play both sides of these things. The calls are how you play it on the long side. The puts are how you play it on the short side. Okay, so as a tier 2 options trader, you have this ability to buy those calls or buy those puts, one or the other. Okay, a tier 3 option trader has the ability to buy and sell options, call options or put options, either side. Okay. And a tier 4, and if you ever hear anybody talk about making, doing spreads with options, they're a tier 3. Razor's a tier 3, and I was glad he typed it in there because there's some fun stuff that you can do as a tier 3 trader. I'm going to show him some of this stuff. Maybe not tonight, but in the chat, I'm going to show him some stuff and give him some ideas because he has the ability to trade this stuff. A tier 4 trader, okay? I'm actually a tier 4 options trader. So what that means is here's what you can do as a tier 4, and some of you guys might get that, and some of you guys can work yourself up to it. I say guys, I'm not referring to men. I'm saying guys in general. So I respect you, Amber, as a lady. All right.
Good save.
Well, it's just natural. So, guys, you can do this, that, and that. But I've had many women in classes, so I got to be careful. All right. So here's what I've done. Here's what I've done. Okay. So I respect the information that Alex has given to the room in the due diligence, as you guys know what that is, that he's done on Wish. I don't know a whole lot about Wish. And he told me, or he told the room, he said, they got X billion dollars worth of money in the bank. If I go to a FinViz chart or a stock chart or a FinViz and look at the fundamentals of the company, I can look at the technical side of things and where they're at, where they're trading at, I can look at the fundamentals and understand everything. They didn't appear to be a great trading company fundamentally for me. However, he came back and he said, it's very popular in the UK. It hasn't seemed to taken off in the United States yet. They have X billion dollars in the. So he gave us a whole bunch of reasons why Wish has some potential. I thought, okay, well, I don't mind owning some Wish then, but I don't want to own it at. When he did this, it was trading right around $11.50 to 80 cents where he bought. But I thought I don't want to own it here, so I pulled up my chart, and I thought, okay, so let me pull that up real quick, stick it in the screen. I went in here to Wish, and I looked at this chart. Is it showing you my chart?
Yeah, you're good.
Okay, so here, this is a stock chart. Let me go in here and hit inspect. There's some things I can teach you about how to use these stock charts too. And I went in here and I saw, okay, back in the end of May, June, first week in June, this thing traded in the $7.80 range to about $8. I thought, okay, the chart doesn't look good. The 50-day, which is this blue line, 50-day moving average is under the red line, which is a 100-day moving average. These are Bollinger Bands. The dotted green line is what's called the means for the Bollinger Bands, and that's your 20-day. And then these are two standard deviations. So, the 50 is trading under the 100. The blue is under the red. The 20-day, not too long ago, just crossed underneath the blue one, which means the 20-day crossed below the 50-day. So these aren't real bullish things, if you know anything about charting. But I did see, okay, it did seem to find quite a bit of support at that $8 range, as you can see over here. I was like, so, okay, I wouldn't mind owning some shares at $8. So I told myself, okay, I'll take everything that Alex told the room and I'll put it into a little bag and say, okay, this is why he says this is a good stock. And I said, I will take shares at $8 if I can get them, or $8.50, somewhere in there. So what I did is, as a tier 4 trader, let me get rid of that. Okay, so what I did 2 weeks ago is can you guys see me circling it on the put side over here? Okay, as a tier 4 trader, it allowed me to go in here and sell whenever you see someone in a room talk about selling naked options. If they say sell naked, don't talk to them because that's a different thing. If they're selling naked, we don't want to know about it. But if they're selling naked options, what they're doing, and I did this. I did it 2 weeks ago when Wish dipped. The one that I have highlighted over here, let me highlight this one so it doesn't confuse y'all. The one I have highlighted at the top here, what I did 2 weeks ago is this 850 strike, okay? This 850 strike was trading in the 26 bid 28 ask range, and I got filled at 27 cents. I did 5 contracts, okay? So what I did as a naked seller is I sold the 850 puts, okay, for 27 cents. So what could happen to me with that? So these are showing 0 to 1 right now, which is good. That's good for me. 2 weeks ago, when I started doing this, I sold the first batch of 5 contracts for 27 cents. So I collected what, 135 bucks. Okay, and the stock dipped. If the stock's going down, these puts are going to go up. Okay, so I let it go down a little bit, and when these got to 27 cents, I thought, okay, that's a good enough premium for me to collect that in the event the stock trades under $8.50, because I'm the put seller, they will assign these shares to me. And I told myself, okay, at an 850 strike, that's where I saw a lot of support in the 8 to 850 range on that chart I just showed you. I'm willing to take some shares at that. And in this case, because I got 5 contracts, I'm basically saying I'm willing to take 500 shares. Okay? My 500 shares would come to me at $8.50. The 2 weeks ago when I did it. Those expired worthless because it stayed above 850. It got really close. If you look at it, it got really close. I was like, dang, I'm going to get these shares assigned. It got close, but it didn't go below, and it didn't close below at the end of that week. So that was my first round of selling puts against this underlying stock at 850. So I collected 27 cents. So if you take your calculator and take $8.50, which was the stock, the premium I was willing to, the strike price I was willing to take them at, and subtract 27 cents. That's now my true cost of what the shares would be had they been assigned to me, but they didn't. Okay, so then last week I sold them again. All right, so this time I sold them last Friday, and I got 28 cents for them. Okay, and I sold the same 850 strike, so I got 28 more cents for them on the 5 contracts. And as you can see on these 850s, they're at 0 on the bid and 1 on the ask. So as you can see tomorrow, those again are going to go worthless. So now what I've done is I've reduced my cost from the 850 they're not going to get assigned tomorrow unless this thing drops from 998 to under 850. Not likely, but if it did happen, they would get assigned. But it's not likely to happen. So now what I've done is I've reduced my base cost from $8.50 minus the 27 cents I got last week, minus the 28 cents I got this week. So I'm under $7 now. I'm around the 790 range. Okay.
Yeah,
so,
795.
Right. So tomorrow, unfortunately for Alex, I'd like to see the stock drop a little because right now, if I go into the August 13th, which is 8 days, it'll be 7 tomorrow. The 850s for tomorrow are only paying 15 cents on the bid and 17 cents. So while I'm at 795 cost, I want to try to collect a little more premium than 15 or 16 cents. I just do. So I could go to the 9 strike and get my 28 cents again. However, now I'm mixing things up a little bit and saying, okay, now I'm willing to take the shares at $9. And that kind of defuncts the whole philosophy I had originally of why I wanted to enter the stock and how I wanted and where I wanted. So I'm not going to sell those 9 puts tomorrow. All I'm going to do is I'm going to do one of 2 things. I'm going to hope that the thing drops just a little bit. Maybe the job numbers won't be so great, and it'll drop a little bit. I'd like to see those get above 20 cents. I'll sell them for a third time if I'm above 20 cents. Okay? So that's my goal for tomorrow with Wish. If they just stay around here 15, 17, I'll probably still go ahead and sell them, even though it's 10 cents less than what I want. But I'm still staying with the 850 strike, which is what built the whole thesis behind what I'm doing anyway on owning stock from Wish. So my goal is to see it go up a little bit, stock come down and the puts go up, and then I'll sell those again. If I can sell those, say I can get 22, 23 cents out of them. If I can sell those one more time, a third time, then I'm going to reduce my cost from $7.95. Say I get 20 cents. Now I'll be down to $7.75. Okay? So if I can get 20 cents out of those tomorrow, and it will reduce me down to about a $7.75 base cost on my shares. So there's a lot of this going on. You guys just don't know it. There's a whole lot of this going on. And the volume on Wish is not that high, but I can show you stocks where it's extremely high. This is how the more experienced option traders and stock traders try to obtain their shares of underlying stock. This is how they want to get it. Okay, they're patient. They sell these premiums and they keep collecting them. So let's say I sell it for 20 cents tomorrow. Now I'm in it for $7.75 of base cost. Let's say it goes down to $8.50 next week, and I get the shares assigned to me. Okay, let's theoretically say, okay, it went to $8.40 by next Friday. I got my shares assigned to me because I told them, if even at 20 cents on the 8.50 strike, I'll take the shares at 8.50. So let's jump forward to next Friday and say it trades at 8.50 or 8.40, and these 500 shares get assigned to me. I now had them assigned at $8.50 to me, but I've sold three put premiums on them to reduce my base cost down to $7.75. Y'all with me on that?
Yep.
So
So, I'm sorry.
go ahead.
This one is just for, uh, you know, for you because you are tier 4.
Tier 4, yes.
But yeah, but for me, I don't have any experience, so I cannot do the kind of stuff that you are doing.
You can, you just have to be guided. So you don't want to go to your broker and say, approve me for tier 1 because I don't know anything about options and I don't want to get myself in trouble. You only get yourself in trouble when you push the enter button. When you submit a trade, you either do well or do poorly. But that's the only time you can execute trouble. Okay? So you want to get approved as high as you can and have the ability to do this stuff, even though you may not do it on your own. Okay? I'm in the room every day. These guys invited me into this room. They didn't even know I knew a lot about options. I taught this stuff for 12 years at night. And so with me in that room, I can help you at night. I'm always available. My kids are grown and moved out. I got nothing to do but jack with stocks at night or hang out with the wife and watch Netflix stuff. And so I have that ability. So you guys, I can walk you through trades. You don't have to necessarily take them. So when you say I can't do that because I don't have any experience, that's in your own head. You don't have experience yet. We can get you experience. I can get you very experienced. It just may take a little bit of time. All right. So now, Razor, you understand. I now got the shares assigned to me at $8.50. I have a base cost on those shares of $7.75 because I sold 3 premiums 3 weeks in a row, one for 27 cents, one for 28, and then a final one for 20. So each time I sell that premium and they expire worthless, that becomes that much less off my cost basis of the underlying shares each time I can get away with that. Theoretically, if you could do it for 6 months or 8 months, you could get yourself to where if you got assigned shares, you didn't have any cost in them if you've sold enough premiums. If I could do this for 6 months and get, never have them assigned, at some point my base cost could be $1 or $2. Okay.
Yeah, you'd be in the money instantly.
Right.
Way in the money.
Right. Okay. So now let's flip forward to next Friday. I got the trade. It closed the day at 8:40. I got the 500 shares assigned to me because I'd been selling 5 contracts, and I now have a base cost on my shares at $7.75. So what I'll do now is on that Friday is I'll flip. I can't really do it until Monday because they won't assign them until over the weekend. That gets done on Saturday. All right, but now let's go over here and say, okay, now I own 500 shares of the stock, and my cost is $7.75. So I can play a little different game. Oh, okay. Hang around, Alex. We're talking about your favorite stock, Wish. And we're talking about how I might potentially own some. All right, so now what we do is we flip back over to the call side. Okay, now I revert back to the tier 1 approval and say, okay, now I own 500 shares and my cost is $7.75. So the difference between the situation that you guys would have been put in had you bought them at $9.50 today, and we were talking about Razor selling a $10 strike for 67 cents, my situation's a little different. I could actually theoretically go in here. Now we're skipping forward to next Friday. It's trading at 8:40. Okay. I can go in here and sell a $9 strike, or I can sell a $9.50 strike, or I can sell a 10 strike. I have a lot more options available to me because my net cost on the underlying shares is only $7.75. So in that situation, if I were to sell like an $8 one, at $2.09, okay, so it dropped to $8.40. I got the shares assigned to me at $8.50. I have a base cost of $7.75. Now I flip to the call side and I start selling covered calls. Okay, so let's look at the 8 strike. I have it highlighted on the left side over here in dark blue. Keep in mind I can sell an 8 strike because I paid $7.75 for my shares. So let's say it just goes back up to $10. Okay, what'll happen is I'll get my shares called away from me this time because it traded above $8, and that's the call premium that I sold. So I said to the market makers, if I can collect $2, it's 201 on the bid, 209 on the ask. So my say I fill at the mid of 205. So I told the market makers for $2.05 per contract, I will let you have my 500 shares the following Friday at an $8 strike. You can call them away from me. So two things happen here, neither of which are bad. Okay, unless it goes to where again the stock has a big tank and I've got covered calls sold on it, which I told you guys about a little while ago. That would not be a good situation. But let's just take the other two scenarios that could possibly happen. So let's say it goes up to $9, or $9. Let's say $9. Okay, I sold an 8 strike, so they're going to call those away from me. Well, my cost is $7.75. So if I get them called away at 8, I make 25 cents on the 500 shares before I get them called away, and I make this $2.06 premium, which is $206. Okay, so if they get called away, I got the $2.06 premium, and I got the 25 cents, which is the difference between my cost on the shares and the $8 strike that I sold, where they will call them away from me. So if they get called away from me, I didn't lose money. I still made 25 cents on my shares and $2.86, we'll say, 205, $2.05 on my premium on the call premiums that I sold. Okay, so now my shares are gone in that scenario. Situation number 2, let's say it goes down to $8 or $7.50. Let's say the news was hard news and it dropped it to $8.40, which is where I got them assigned, and now we're down to $7.40. Alex is freaking out because these things are trading at $7.40. What happens then not next week, but the following week? Let's say the stock closes at $7.50. We'll use that to make it easy. All right. I have a base cost of $7.75 on my shares, and it's now trading at $7.50, so I'm down 25 cents on my shares. However, I collected $2.05 in premium. So that $2.05 is now another value that gets taken off my base cost of my shares of $7.75. If you remember, I had shares I had handed to me at $7.75. Let's say it trades at $7.50. Now this call premium, the $8 strike call premium of $2.05, went worthless also. So now I have shares that were $7.75 minus $2.05, and now I'm down around $5.60, my base cost. So Razor, did you see how that worked? I sold premium on the put side until I got shares assigned to me that I actually wanted at a cost. And right now I'm on my second week, fixing to be my third week next week. I got them. I'm not to the point where they're signed, but if next week I get them assigned to me, my assignment cost is low enough that I can sell a lower strike and collect more premium than you can if you bought your shares today in some calls. And now all of a sudden, let's say it goes down to $7.4 and those go $7.50 and those go worthless. I now have a $5.50 net cost or base cost on my underlying shares. I still have my 500 shares. That makes sense?
Yeah.
Okay, so that's the way you want to buy stock. That's how I buy stock in all the institutions. That's how they do it. They do it the way I just explained it to you. That's how they get ownership of shares of anything that they want. They don't just go in there and say, well, on the chart, this 950 looks pretty good. And the next guy sitting to him says, in the room, says, no, man, that's a falling knife. And this guy says, well, I can catch the bottom. None of that's going on here. They're not saying, well, I think it's going to, I'm catching the bottom. it's a falling knife, and they're arguing about it. And they don't do that. They do what I did here. So, worst case scenario that could have happened to me in this whole setup is I have 500 shares. I sold an $8 call strike, and I collected $2.05 premium. So now my base cost is on the shares is $5.50 or 60 cents, and the thing for some stupid reason drops to $3. Okay, well, I would probably feel much sorrier for Alex with it being at $3 when he has them at 11.85 than I would for myself for the $2 that it got me for. But that doesn't necessarily mean it's over with for me yet. What I can do at that point, I can still sell covered calls. Okay, so if let's say that theoretically happened. Let's say that stupid thing dropped at $3. Well, the calls went worthless. I still own my shares, but I was able to take the call premium off my base cost. So now I'm down in the 550 range. So I own shares at 550, and the stupid thing went to $3. So now I'm down $2.50. Okay, I can continue to sell covered calls against those shares. But what I want to make sure I do is sell the premiums at a strike that is higher than my base cost. I don't want to sell, if it's trading at $3, I don't want to sell a $4 strike, because if it jumps over 4 and I get them called away, I then take a realized loss, because my cost is $5.50 on the shares, and I sold when it's trading at $3, I sold a $4 strike, and if it jumps to $4.50, I get those called away from me at $4. I have then taken a realized loss of having a $5.50 cost on my shares, and I let them go at $4, so I took $1.50. That's a realized cost. So what I would want to do at that point is, even though the premium will get reduced considerably on how much I can collect, I want to sell them at no less than $5.50 or $6. That makes sense?
Yep.
So this time, this time you already own the
The 500 shares,
uh
correct. I've had them assigned to me back from the put side.
okay. So
So now,
it's not just that I'm sorry, I did not understand everything that you said, but maybe I will in the future.
I'm
But
recording this. I am recording this. I'm going to paste the recording in the room, so it'll show my screen share and everything. So you can watch this thing again or until you grasp it. But if you want to get involved in options, you want to make sure you watch it till you grasp it. It may be boring to you, I don't know, but watch it till you understand it, and then it'll start to click. I'm spelling it out in great detail. Anybody in this room that had any, reasonable amount of option trading would be bored, because they know a lot of this stuff already. But because you guys are all brand new at it, I want to make sure I start from the bottom and work ourselves up. Okay, so you understand that we had the shares assigned to us over on the put side when it went underneath the 850 strike that I was selling. Then I got those 500 shares assigned to me. I had a base cost of 775. Now we've flipped over to the call side, and I'm back to my tier 1 trading, where I'm selling covered calls on those 500 shares that I own to try to collect some more premium. Worst case, the stock drops from 750 down to $3. Probably not likely with Wish, but that would be the worst case scenario, where it dropped to $3 and I still have a 550 cost less, or a 775 less the couple bucks I collected for this premium. I'll still be at 550, in that range. So I'm taking a $2 loss, but that's not likely to happen. All right, so Razor, we've been doing this for like 47 minutes, so I don't want to give you guys too much information. I do kind of want to cover the Greeks if you guys want to know it, understand it. So, because I've told you the 4 levels of trading are tier 1, 2, 3, 4, and what you can do. Did y'all understand that? Tier 1 is the covered calls. Tier 2, you can buy calls and puts. Tier 3 is you can buy and sell calls and puts. And Tier 4 is you can do naked options. I showed you the naked option part that allowed me to get shares assigned to me if at some point that happens with the puts. I don't want to get into the tier 3 tonight, because it's more complex, more complicated. It'll be an hour or two by itself to understand buying and selling options, both of them. And that's where all of the multiple strategies come in that you hear. If you ever hear option terms thrown out there like strangles and straddles and butterflies and verticals and iron condors, I'm sure all y'all heard some of those. All those terms require margin and a level tier 3 approval to be able to do them. So I don't want to go into that because that's a whole basket by itself tonight. But if you guys want to take just a little bit more, I can explain to you. And Razor, you may know this or not, but if not, you'll benefit from it right out of the gate on how these Greeks work. If you want me to do it real quick, if you had enough, we can hang it up.
Yeah.
Okay.
No. Yeah,
right.
Keep going, man.
Okay, cool. There's 5 things that influence this option price, no matter what the option price is. There's 5 things that influence it. The first one, if you look up here on the left side on the call side over here, the first one I'll circle is called delta. Okay? The second thing that influences an option is called gamma. I know you guys have heard people say, it's got a gamma squeeze. 99% of the people that hear that don't even know what it is. They don't even have a clue what they're talking about. They just go, yeah, okay, it's getting a gamma squeeze. Boy, that's horrible. Or that's great. They don't even know. Okay? That's an option term. And these 5 things that I'm telling you that influence the stock are what's called the Greeks. Why they call it that, who came up with that, don't know. But that's what it's called. So if you ever hear anybody that says, well, you option trade, do you understand the Greeks? After tonight, or at least one more lesson I do, you guys will understand the Greeks. So you can answer yes to that. Okay, so that first column is called delta. The second column is called gamma. So when you hear someone say, oh, this is getting a gamma squeeze, this is what they're referring to. Okay? The third column is called theta. The fourth thing that influences an option price is called vega, and that's the influence of implied volatility or how it affects the option. Some people misunderstand it and they say, well, it's the implied volatility on the option. Well, there's not a true value of implied volatility. It's the sensitivity of the option to implied volatility. That's what it is. And then the third one is called rho. I don't even have it on here. It's how options are influenced by interest rates, and we don't care about that. Okay, I'm going to go over here to the second batch down for next week's stuff, and we're going to go back to what we originally talked about with Razor saying, hey, I'm going to buy, he's a tier 2 trader, I'm going to buy the $10 call for 67 cents on Wish. Okay, he's saying, okay, I think it's going to be above 67 cents. If you remember right, I stated technically, mathematically, for him to make money, it has to be trading about above $10.67, because if he's trading a $10 strike and he paid 67 cents for that, then wouldn't it need to be above 10.67 for him to actually make money? No, it doesn't. This is where the retail traders come in, and they're not trading call options to try to get ownership of the underlying share. Because right now we're doing it on Wish. In one of these classes, I'm going to cover doing it on stocks like SPX or SPY or Tesla or Amazon, stuff like that, to where you can do the exact same thing we're talking about here, and one contract will give you control of 100 shares of Amazon. So you're talking about several $100,000 that you have control of with one contract. So, we're doing it on Wish tonight, but you can do this exact same thing on everything else. So now you say, okay, so he bought the 10 strike call, and he paid 67 cents. In my mind, it would tell me that at 10.67 is where he starts making money. That's not how these work, okay? Like I said, institutions are buying to own shares. He's a retail trader, Razor's a retail trader, and he's trying to make profit off the premiums is what he's trying to do. So let's go. We got this blue line. Let's go over here to the delta column, okay? Can you guys see where that says 0.529? You see this where I'm circling it here?
Yep.
What the delta represents is a percentage of movement. It will move based on a $1 movement, the first $1 movement of the underlying stock. Okay? This number represents, and you can use it as a dollar value. It's a percentage. So it's saying it's going to move 0.529 cents. What this means is if Wish moves up $1 or down $1, the option itself, his 67 cent option, will be influenced by this number. So if let's say he bought the 67-cent $10 strike call, and next week at some point before the 13th, which is next Friday, Wish goes up $1. It could. It was $8.50 or close to $8.50 a week ago, and then it made it all the way up to 10 something. So let's say it goes up $1. Okay, if it goes up $1, the delta is the amount of value that will be added to the cost of that option and how much it will trade at based on that first $1 move. So in this case, if he paid 67 cents for his option and Wish goes up just $1 next week, he's going to get 52.9, or let's call it 53. He's going to get 53 cents added to his premium. Okay, so keep in mind now, he's playing around with 100 shares of Wish stock through options. If you had 100 shares of the underlying at $9.50 that he bought them at, he'd have $950 tied up into this play. Whereas he bought $10 strike calls for 67 cents, he's got $67 tied up in the same play that someone else is trading the stock on and has 970. So number one, the influence on your capital in your account is considerably less. So he's now got $67 tied up, and then if he does one contract, okay, and the first $1 move up, it's going to add 53 cents to that option premium. So now that thing is, you got the calculator. What that thing, let's say Wish goes up exactly $1, and it's by next Thursday. Okay, what's your premium going to be worth? You there?
$1.21.
It'd be 53 cents plus 67 cents. Yes, $1.21. Okay, so now he's only put $67 on the table. That's for one contract. You can do 3 contracts, 5 contracts, 10 contracts, whatever you're comfortable with. So now all of a sudden that thing's worth $1.21. So you're up about 70% on your premium. So your premium went up about 70 cents. Well, the dollar move for whoever owns these shares underlying at $950, a dollar move doesn't bring them up 70% by any means. It's nice. They're like, yeah, I got 100 shares of the stock or 1,000 shares and it went up $1. That's great. But in Razor's case, he's got 67-cent call options at $1 move that just went up 53 cents. Okay? Now, that's the delta column. The next column is the gamma column. What's going on there is that is how much percentage-wise, or you can use it as a number, will be added to the delta on the next $1 move. Okay? So, we're at $9.98. Let's make it $10 to make it easy. Next week before premium expires on Friday, it goes to $11. Well, his 67 premium call went 53 cents more, so now he's $1.21. Let's say it goes to $12. Let's say they just drop some killer earnings or something comes up and Alex convinces the United States that Wish is as good as Amazon like it is in the UK. And it goes up to $12. Okay, so what's going to happen on that second dollar move is it's going to add the delta of 53 cents, and it's going to add that gamma of 23 cents to the delta, which is now going to make that 75 cents. So on the first dollar move, he got 53 cents. On the second dollar move, he's going to get 75 cents. So now add 75 cents to your $1.21, and you're at almost $2.
Yeah, pretty much.
Yeah. So what he bought for 67 cents, if Wish goes up $2, is now at $2. So his $66 or $67 investment is now worth $200. Okay. So he's up 150%. Okay. The guy that owns the underlying shares is up $2 also, but he's not anywhere close to 150%. Not even close. He's happy because he's up in his shares, but he didn't make 150%. Do y'all follow what the gamma does and what the delta does so far?
Yep.
We good? Okay. The next column is called theta. Theta is your time decay. Okay? Theta is the one thing that happens no matter what else happens. The theta amount, and keep in mind these are all, like I said, they're theoretic values, so they change day to day. But the one thing that will for sure happen to this option is your theta is your time decay. Okay? As the time ticks away on the option and you get closer to premium, you lose that theta amount every single trading day. So in this particular case, this thing has a theta of 4.5 cents, 0.045. So tomorrow morning, if you bought it that today at 67 cents, regardless of anything that happens, that theta or time value is going to take 4.5 cents off that premium value. So he's automatically lost 4.5 cents, regardless of what else goes on around it. Does that make sense? And that's each open market trading day. Because I've had a lot of people say, well, why doesn't someone like you that has a tier 4 sell these options on a Friday and then on a holiday weekend and capture that 4.5 cents of theta over the 3 days everybody's off? Most people don't get that. It doesn't work like that. The theta is calculated based on open market days. So when the market's closed for 3 days on a Friday, Saturday, Monday holiday, Saturday, Sunday, Monday holiday, there's not 4.5, 9, 13.5 cents of premium decay that falls out of there on Tuesday when it opens. It doesn't work like that. If it did, it would make it so simple for guys like us that understand these things, because I would do that. I'd sell these premiums and I'd sell it for 67 cents and it would open 12 cents lower on Tuesday. It doesn't work like that. But any open market day, you lose 4.5 cents on your premium. Okay? Implied volatilities, that number is pretty much, I just showed it because there's pretty worthless. Implied volatility, when volatility goes up, it can go up into earnings. It can go up into, if you watch stocks, most of the implied volatility is going up as the stock's getting closer to earnings, or if it's a company that's looking for an FDA approval, or any of that kind of stuff can increase volatility. And when there's an increased volatility, or even if the market just, starts to get nervous, an increase in volatility is an increase in premiums for stocks on the option side. So it can go up from 67 cents to 74 cents just in a big implied volatility spike on the overall market. So if volatility starts to go up, it goes up in the premium. So that's a way that you can make money off them. Also, however, if you bought the thing right before an earnings or something, chances are the implied volatility is really high already on those premiums. And then once you bought the rumor and then the news comes out about the earnings and whatever it is, the implied volatility gets knocked out of there, which then reduces the premium considerably. Okay, so that's where the delta comes into play on an option. It's which is the movement in the option price on the first dollar. The gamma gets added to the delta, and that number combined is the movement on the option in the second dollar move. And then the theta is how much is deducted off that option premium every open market day. Okay, so those are the main factors that influence your option pricing. A spike in volatility can make it go up, but I saw so many people for so many years say, "Hey man, I played options on Wish into earnings and stuff, and I paid 67 cents for my option call on a $10 strike, and the thing went up $1, went to $11, and my options are at 40 cents. What happened? Well, it's because there was so much implied volatility, built into those option premiums that as soon as everything got put on the table, the reality of what's real, they pull that volatility out of those options, and they aren't worth that much anymore. They get, especially when an expiration that's only 8 days away, they're going to get closer to their intrinsic value. Now, does that make sense? Did you already understand the Greeks, Razor?
Yeah, pretty much. I didn't know as much detail as you told me, but I already knew most about them.
Okay, good. All right. Amber hasn't said anything. Alex, I don't know if he's still here. So that's when you hear somebody talk about Greeks, that's what they are talking about. Okay. The next column in my thing I have laid out here is you have delta. Hey, girl. All right, you got delta, gamma, theta, vega. We've already talked about. The next one I have is volume. Okay. This one's real important when you guys are looking, even when you're just looking at your stocks that you want to invest in. Oh, let me back up real quick. The numbers that I gave you that influence the stock price, the option price, those numbers work both ways, up and down. So in the case that Razor owns $67 he paid for that call premium, if the stock drops $1, then that 52-cent delta comes out of that premium. So now he went from 67 minus 52, he's down to about 15 cents or 12 cents. So the inverse works exactly the same. So if the stock drops a buck, now his premium loses 52 cents, and that's where you see a lot of people say, "Oh, I don't like playing options because you can lose 100% so easily." Well, yes, you can. You got 67 bucks invested, and if the stock drops $1 the next day, you lose 53 cents of your option premium. Now you're down to 13 cents. So yes, you theoretically could lose 70%. While you gain 70% the other direction when the stock went up, you could lose 70% of that stock value also on the way down. The nice part about trading options, other than the naked stuff, the naked options that I trade and I told you about, on any of the tier 1, 2, or 3 options that you trade, your risk is always 100% defined. You know what the most is you can lose. And in this case, it was his 67 cents per contract. Say he did one contract, he has $67. Say the stock closes at $9, those go worthless. He lost his 67 bucks. That is the most he can lose on this option trade. That's the nice part about options is you can look at it and you can say, okay, so on the 9 strike, it's $1.22. You say, okay, so I have 122 bucks in this thing. If I'm right, I could make money. If I'm wrong, what's the most I could lose? $122. You will always know what your risk will always be defined on the first 3 tiers. Okay, so what was I doing next? I lost track of it. Oh, volume. Okay, I got 2 columns showing here. One of them is volume, and the next one says OPE. That stands, it's short because it's too long to fit in the column. It stands for open interest. Okay, that used to be a fun thing to use. They don't let you use it anymore. What the volume is we don't have any way of knowing, and I wish we did, because if you really know how to trade options, you could take the volume, if you could dissect it, and you could determine the direction of a stock. So they don't let us understand or know you guys still with me? Because my video cameras just flashed, which leads me to believe that.
Yeah.
Yeah, we
Okay,
can
I
hear
want
Still
to
here.
make sure I didn't lose my internet signal because all my cameras are flashing. What the volume is the volume is how many contracts traded for that particular open market day. In this case, on the 10 strike, we have 2,302. So 2,302 contracts were traded on the 10 strike for Wish for next Friday's expiration. We don't know if they were bought contracts or sold contracts or part of a spread or part of an iron condor. We don't know what they are. They don't dissect that for us. They don't give us the liberty of knowing that. If they did, it would make things a little easier because it would let us see where people are leaning, right? So in this case, if the next column is open interest, what open interest is that is what is already on the table. That can be bought calls, sold calls, spreads. It can be a combination of many, many different option trades, but it is what, when that market opens that day, that is what is still on the table. There's still 5,447 contracts that are open on that 10 strike call. That existed this morning when that opened. Now, 2,302 volume came in today. The volume is what comes in every single day. That one changes. The open interest will change at night. Okay, so whatever that 2,302 contracts of volume that came in today is, it will influence that open interest tomorrow when it reopens. It could be half of that could be bought calls. To where now 1,600 gets added to the 54, which makes it 7,000 tomorrow. We don't know. We don't know if those options were bought or if those options were sold or how they influenced that particular number. But you will see the number change tomorrow. If you look at this here, this is a thing that it makes it so. I talked about this earlier. That's a volume candle. That's an open interest candle. And if you know in the room, okay, the next I want you to see this too. The next one is the low and the high and the net change. So on this particular option, the low, if you look at this column, was 55 cents today. Okay, so on those 2,302 contracts that the volume that traded today, 55 cents was the best price. The worst price someone got, and 70 cents was the best price somebody got. So in that 55 to 70 cent range, if Ranger filled at 67 cents, he didn't get a great fill because he's towards the top end of what that thing traded today. If you were selling covered calls and you own the underlying shares, then you did good because you want to be towards the top end of what they traded at. because you're selling those calls. Okay, and then the net is the net change from what it did yesterday. Okay, now the next column here, that's the last. It closed at 66 cents today. The next column here is what's called, you can't see it because it's too small, but it's called probability of in the money. Okay, so that's a percentage that tells you what the probability is at expiration for this $10 strike call to actually stay in the money or be in the money. And in this particular case, it says it's a 46%. Options, that when options trade, one of the things to remember I told you there's in the money, out of the money, and at the money. Most options trade at the money at a 50 delta. They trade right at half, 50%. Okay, so that's why, because it's at $10 and the stock's trading at $9.90, it's right there at the share price. That's why this is at about 46.5, 46.13. The at the money options trade right at about a 50 delta, which that's why it's 52 cents, and about 50% probability. So they're basically not giving you a whole lot of help here of whether or not these things will actually be in the money. It's telling you you got a 46% chance they will be in the money. Okay, so those are what all the columns are. So that's the columns that are probably the most important to have on your thing. One of the things that used to happen, and this doesn't happen anymore, and if you were good at calculating things, I'm not going to do it. Let me do it on a stock that has a little bit more. Did y'all follow? Let me ask you this. Let me back up. Did y'all follow the columns? Any questions on any of them columns? We've got a delta, how it influences it, gamma, theta, vega. The volume column is what it does during the day. The open interest is what's already left on the table from the day before. It's what's still open. And the volume will adjust that number tonight. It gets a low number, what the lowest that contract traded at for the day, and the high is the highest it traded. The net is the net change. The last is where it closed, and then the probability of in the money gives you the probability or percentage of whether or not that option will actually be in the money for you at August 13th, next Friday. It's not really helping you when it's 50% because it could go either way. Everybody understand those columns?
Yeah. I just have one question.
Yep.
I'm on Thinkorswim as well.
Okay.
I don't see these columns.
You have
You go to add them.
Yeah,
have
I
to
figured
set
do
them
I
up.
have to call the broker
Yeah.
to enable them?
No. If you'll
Or-
go
No.
to right above, see where my little thing is circling where it says layout? See where I'm circling it on the screen
Yeah.
share? Right click on that, or no, left click on that, and go, no, yeah, left, left click the button where it says layout, and go to
Mhm.
customize. Go down the drop down box to customize.
Okay, got it. Okay,
And
I
I'll
can
leave
see. I
mine
can add them
showing
all
here real
now.
quick so you can set yours
Okay.
up to match it. Put the delta at the top,
Gotcha.
then the gamma, theta, vega. There's probably gonna be some other crap in there. Get rid of it. The
Okay.
sizzle thing and all that garbage. Get out of there. You only want to see what actually you need. So delta, gamma, theta, vega, volume, open interest, low, high, net change, last X, probability in the money. Put all those in there and hit OK, and then your columns will line up like mine do.
All right, got it. Thank you.
All right. So in the past, let me find one that has a little better, more options. Let me go to AMD. That's probably going to have it. Okay. Now look at these columns, okay? Here's how things used to work back when I started trading options many years ago. What they used to do is, this is the options for AMD, okay? They're a little more pricey. But what they used to do is it's trading at $112.35. So I'm going to highlight those particular ones, okay? Here's what most people don't see and don't understand. So I've highlighted the left side, which is your calls at the 112. Those are at the money. And I've highlighted the right side of a 112. Those are at the money. And look at the volume on this one today. Okay, the volume far exceeds the open interest for tomorrow's expiration. So like the 112 strike calls is trading at 112.35. The one trade has 18,000 volume and only has 8,900 open interest. Okay, look at all these huge numbers. So it'll be interesting tomorrow to see what those numbers, how they are reflected into the open interest. See, like the 57,146 on the 115 strike. Okay, you see that? See me-
Yeah.
I'm circling here. Okay. What you want to do is you want to look at how you want to screenshot this, and then look at how these huge volume that came in today actually are reflected in the open interest tomorrow. Okay. Now it's probably not going to affect this stock. However, several years ago it always did, and it made it really easy to trade this stock. And I'll tell you why. Okay, so if let's just say they stick that 57,000. See the 57,001, not 46. Let's say they stick that over into the open interest, and all that was people buying, or most of it. Let's say most of it was people buying. And tomorrow, when you open this back up, that 115 strike in calls is going to have 75,000. Let's say most of it was buyers that found out something about the company, insiders, whatever. Whatever made a whole bunch of people interested in owning the stock or buying and playing the option calls. Let's say that's a 75,000 number tomorrow. The open interest. Okay, if you take that, that's at $115. Okay, if you take the $115 minus what the stock is currently trading at, that's $3 roughly. Okay, so let's say that number becomes 75,000 open interest tomorrow. All right. If you take 75,000 contracts times 100, because one contract is equal to 100 shares, and then take that times $3, which would put the 115s in the money. Now, this is a theoretical scenario I'm setting up for you, so that you understand how we still kind of can do it, but not as much as we used to. I want you to see that when you're trading your stock, here's something you can look at. So let's say that 57,000 was a lot of buying interest, and it goes over into the open interest column, and tomorrow morning we wake up and that's 75,000. Okay, 75,000 contracts times 100. Do the math on that, and then take that times $3 or $2.50 actually, which is the 115 strike minus the current trading price of $112. Take 75,000 times 100 times $2.50 in the money, or it would be in the money. They are going to probably stop that thing right there because they don't want that much option interest going in the money. Y'all follow me? So tomorrow when that thing's trading, let's just, again, it's theoretic. 57,000, 50,000 of that moved over into the open interest. Now there's $75,000 sitting on that 115 strike call. If you do the math of 75,000 contracts times 100 times 250 that it would have to go up to get there, it's probably going to stop that stock there or not let it close above there, because if they go above that 115, then all those contracts will become in the money. Whereas right now at $112.35, a 115 strike is out of the money still. So because it's still out of the money, they would not let that go above the 115 because they don't want all that coming in the money. Now, that makes sense, or did that just confuse you?
A little confused. What do you mean they'll stop the stock from going any higher?
Let me go through it again. Okay, so can you see the 21,000? Okay.
Yeah.
Okay, so you see the 57,000 on volume. All right, let's say that was a lot of buying that went on today, and tomorrow when we open this same page, that open interest that's 21,000 now shows at 75,000. Okay, well, 75,000 on a 115 strike, 75,000 contract times 100, which is what a contract is worth in shares.
Yeah, it's
times
$7.5 million shares worth.
Right, so it's millions of dollars. Okay.
Yeah, it's $18 million.
They're not going to want to run that thing above $115, so any of that comes in the money for anybody. You follow me?
Yep.
They're not going to want to run that stock to $118 and let that $18 million be worth that times 3 or another, $50 million. The market makers are not going to let that close with $50 million just on that one strike in the money.
So you can sort of utilize that in like a day trading sense.
Exactly.
You can see that's an extra force of resistance.
Exactly.
Then, because market makers wouldn't want these options.
And you
to
know
be
what's really crazy about this? Probably as early as I did this probably 10 or 12 years ago. I taught a class on this, and we made It's called open interest pinning. There used to be several websites that would calculate it for you, and all you had to do was Google open interest pin, PIN, and it would tell you where the ideal pinning location was for a stock for the market makers to make the most money. And what happened that kind of diluted that is now these stocks are getting such huge amounts of trading. You know, AMD can trade 125 million shares in a day. So because it can do that, it's diluted the options a little bit to where the influence on what's going on with the option is not quite as big. However, when you get stocks that aren't like AMD, where they're getting this massive amount of trading, the options can still influence the price. So if you go to look at another stock, let me pick one here. And it used to be called open interest pin. That you could find a stock so you didn't have to do the calculations yourself. These things you could just put in the stock and the expiration and all that stuff, and it would kick out and it'd give you a response and tell you, here is the premium spot for the market makers to close this stock. And for about 2 to 3 years, that worked like a charm. I taught it in a class right when this stuff was really, really working, and there was a ton of us that made a bunch of money because you could do the pins. I'm going to put it in, what's the ticker for Twitter? TWTR? That one will probably have a bunch. I'm going to show you this.
I don't even know what Twitter
Yeah,
is.
it's TWTR, Twitter. No, it doesn't have a whole bunch. Let me find something that does. Let me show you something else here on the inverse to that. Okay, go over to the right side of the screen. Okay, I got Twitter up for the ticker. Let's look at next week's expiration. Okay, so look, this is not going to influence Twitter by any means because the volume is too high. It's 8 million on the volume. But look at I'm circling right here. Okay, that's a 66 strike, and it has, or I'd go to the 67 strike. The 67 strike has 6,669 contracts that are still in the open interest column. Okay, so if let's say that number, and I'll find one. I can tell you where it will be if I go to the monthlies. These are weeklies. I'm going to go to the monthlies on Twitter. Oh, I forgot to mention, a lot of the larger companies, most of the bigger companies, will all have what's called weekly expiration options. They recycle brand new sets of options for an expiration every Friday. Okay, stocks like SPY, SPX, stuff like that, they actually have them for 1 day expiration and 3 day expiration and 5 day. But the majority of the bigger decent companies will have options that expire that are called weeklies. It's every Friday. Okay, often any other companies that have options will have what's called monthlies. They expire the third week of the month for these companies. Okay, so whenever you're looking at this open interest stuff, go to the I just showed you the weeklies that expire tomorrow on Twitter. I showed you the weekly, the ones that expire next Friday on Twitter. And now I'm going to go to the August 20, which is going to be the third week in August, and those are going to be what expires on the monthly expiration for Twitter. Okay, so go on down here. I'm going to highlight this line right here, and then over on the other side, I'm going to highlight that line right there. Okay, wasn't too long ago. If you look at the one I have on the left side here, you see the open interest of 25,291 on the 70 strike. Okay, if you do the math on that, the 25,291, it's this open interest right here on the 70 strike. That's what's still on the table. Okay, if the market makers keep this stock under $70, every bit of that, whatever's in there, no matter what it is worthless. Okay, because it's on the call side. If it's under $70, there's no value to any of that. So you can see their motivation to keep this thing under $70. That's not a huge one. You know, mathematically, that times 100 is not a really big enough number to influence it. But when you find other stocks and those numbers are really, really large, I can assure you that you see this 27,778 over here on the 75 call, they're not going to run it above that. But think about it. If they run it to that 75, for some reason, we don't know what they're going to do with it, but let's say they run it to 75. That's going to put these 25,000 contracts that are at the 70 strike in the money by $5. So if you take 25,291 times 100 shares, times $5, that's millions and millions of dollars again. they're not going to. The market makers are not going to allow that to happen, to where millions of dollars are paid to the option traders and allow those to go in the money. They're just not going to do it. And the reverse is on the other side over here. There's 14,000 open interest on the 65 strike puts. Okay, and you ask yourself, why the heck is there 14,000 contracts on a 65 strike when this thing's trading at 69 bucks? I wish we knew. I wish they'd tell us, because it would make it a whole lot easier to trade the underlying stocks if we knew exactly what the influence was from the options. I'd love to know how many of those are naked shorts, how many and are willing to take the shares at 65 bucks like I would do, how many of those are bought puts, how many of those are sold puts. If they would actually, break that down on a spreadsheet for us, it would give a huge advantage to a lot of people, so they don't. But think about it. You ask yourself, looking at this like I am, why is there 14,000 contracts on that open interest of a 65? You don't know. But you do know they probably aren't going to let it go below 65 and let any of that go in the money. Does that make sense? But look at this one here. Look at the 70. Again, I don't have a calculator, but look at the 70 strike. It's 8,612 contracts. Okay, and at 69.28, those are in the money. So it's a put. It's below 70. It's at It's a 69. I mean, it's trading at 69.28, and the 70 strike, that would put those in the money. That's why that background is shaded, because those are in the money. The 70 strike. So there's 8,612. If you take that times 100, that's 800,000. Let's see, 10 times.
Yep.
Yeah, that's 800,000. Right now they're only in the money by 70 strike at 69.28 price, 72 cents. So that equates to about $700,000. It's not enough to influence a market maker to bring that thing down. Up to negate that particular line right there at 70 strike, because there's $8.5 million in trade volume on this thing. There's $8.5 million trading volume, 8,600,000 shares traded on the stock. So a $700,000 option strike is not going to impact or influence the direction that the market makers move this thing. Does that make sense to you?
Yep.
But you can find companies and you can find stocks that it does. You can find ones and you don't get to know why it got there or how it got there, but a lot of times you don't care. If I click through enough tickers here, I'd find one and say, good, there's one right there. Look at that. Let's see, this is Newegg. Yeah, see, there's nothing on this one. There's 3,000 on the 25 strike. There's 3,193 on the 25 strike. Call for tomorrow. So let me tell you what people do. Here's what the rookie traders do in options trading, and that's where a lot of this volume comes from that you see. Okay, so you had a whole bunch of people that were penny stock traders. Okay, and then the penny stock market kind of went to crap on us. It isn't what it used to be. It used to be you could buy. It's coming back. But I'm talking true penny stocks, 20, 30 cent ones. The guys that have smaller accounts could play huge amounts of sub-penny stocks at 0.004. So, they put a bunch of shares on, 1 million shares on, and think they were playing big. The true penny stocks are in the $1, $52 and less area. The guys that play that, those stocks weren't moving anymore. But as we can see, they're starting to move again. Some are going to $80 in a day. So what those guys did is they got themselves approved to trade options, and they can buy options. So they're going in here and they're buying options. And let me tell you what they're doing here. They're looking at it. Okay, Newegg, a lot of hype, a lot of talk. Everybody's saying, oh, this is an IPO. It did really good. And depending on what room they're in, they can get some of these crappy Discord rooms and different chat rooms, Omnovia rooms, and everybody's talking a bunch of smack. And most of it's to support their own agenda. Okay, very few. Now that's not the way it is in this room. This is a great room, and for the few guys that are in here, this is awesome. Everybody has each other's back. Everybody knows what they want to do, and they tell everybody. That's very rare for these kind of rooms. But the larger you grow the room, the less transparent the room itself becomes. So that's a really good thing about this room. You get in. I've been in some huge rooms that I moderated. There were 500-600 people in there, and there's legitimately that many people. Most of them all have their own agenda, okay? And they say stuff, and then you got 80% newbies that are hanging on to it and going, well, this guy, he sounds like he knows what he's talking about. So if he thinks Newegg's going to go up, I'm going to go into here and buy some calls because they're cheap. Well, cheap doesn't necessarily mean it works. In fact, most of the time, cheap and working and probability of success don't go together. Okay, because if it did, everybody would be on that boat. So let me show you an example on this Newegg stuff for tomorrow's expiration. There's 1,260 calls on this thing. We don't know where they went. There's only 272 in the open interest, but there's 1,260 contracts on the 25 strike calls. So they're 39 cents, 48 cents, crappy spread. However, for 40 cents, so for $40 for one contract, everybody and their brother can be a penny stock trader. They can say, well, for $40, I can buy a 25 call strike on Newegg, and by tomorrow, if that thing goes to $25, I score. Theoretically, if it only goes up $1, which it could do, if you go over here to the delta column, it's got a 20-cent delta. Okay? So they're looking at it and going, okay, well, cool. I paid 43 cents for this thing. If it goes up $1, somebody told me that the delta on that thing is 20% or 20 cents. I'll go up 20% and I'll make 50% of my money. But what that person forgot to tell them is the theta on the thing is 43 cents. So theoretically, by tomorrow, the thing's going to open at zero. So if they bought them today, they get a zero tomorrow. And so that's what happens here. And you see some of these with these huge volume numbers way out of the money. It's guys taking big swings for the fence. They look at it as okay. They used to trade penny stocks, and they could trade stuff for 30 cents, 40 cents, 50 cents. And in this particular case, for 40 cents on one contract, they got $40. They take a hard swing at the thing and say, okay, if it goes to $25, I'll make some money. Well, the reality is it's not going to, because if you look at the probability in the money, it's only 14.5%. It's not totally dead. It's not like it's 5% chance. It's got a 15% chance. And if you start looking at options, you'll see there's a ton of that going on. Look at this. Look at this 15th strike, August 20, 15 days from now, August 20 strike. There's some stuff going on. Let's look at it here. Okay, so let's go over to this side over here at the 49. I'll highlight it on the put side. Okay, blue the highlighted line. There's 4,931 open interest on the 1250 strike. The stock's trading at $20.33. But every Nimrod out there looks at it and says, hey, for 33 cent bid, 38 cent ask, I got about 35 cents or $35 in one contract. There's 4,000. They don't understand how open interest works or volume works or anything or what makes it up. They look at that and they say, wow, there's 4,931 other people that think this thing's going to go down to $12.50. That's their being, oblivious to what's really going on. But as you can see, if you didn't know anything about options and you started scouting around, you'd look at this and say, wow, 1250 strike. It's trading at 20, so it doesn't really look like it'd want to go that far. But there's 4,931 other people that think it's going to. So they jump on the bandwagon and they buy one for 35 cents. And they think, hey, I got $35 in it. It's either going to be my next buy my Lambo, as you hear in every single room a million times, or I'm going to lose the $35 and I don't care. Well, when you start going through millions of options on 7,000 stocks, there's millions of people that have the I don't care going on $35 and $65, and the market makers are loving it. That's what's going on a lot when you see these huge numbers. For $35, they can participate in something they don't even know what's going on. Does that make sense to y'all?
Yeah, so wouldn't it be really advantageous to just sell these really far out of the money calls and puts?
That's what I do. That's what I'm going to teach you in the next class. Yes, you can sell naked options even in an IRA as long as they're cash secured. So, in other words, if I sold, 50 contracts of this NEG for a $12 strike and collected 40 cents or 44 cents, as long as my account can handle me getting the same 5,000 shares, it doesn't matter. You can sell them that way. You cannot sell. That's called cash secured puts. If you sell them and you get them assigned to you, and your account can cover it, the worst that can happen is the shares go up, and you already have the shares assigned, or the shares go to zero. Neither of which will hurt the market makers. It'll only affect you. You cannot sell naked calls except in an account that has margin. Okay, because theoretically a stock could go up forever. So it could go up if you just say, I'm going to sell calls. This thing's trading at $20. I think it's way overbought. I'm going to sell $25 calls. The $25 calls are $1.75, $1.53. You can say, hey, I can collect $1.60 in profit, $160 for each contract I do. You can do that, and that's naked call selling, but you have to do it in a general account that has margin on it, because theoretically the stock could go up to 80, as we've seen, and then you'd have yourself in a little bit of a situation because you sold.
Yeah, then you had to buy him a Lambo.
Then you have them knocking on your door, and the market maker's going, hey, surprise, you got a margin call on you. What'd you say his house was worth? Zillow says worth $800,000. You owe it $600. So just could you pack your stuff and go out to the road? So that's why you could do the naked call selling, but only in an account that has margin. So you have what's called a maintenance margin in your IRA. So on these cash secured put accounts, you can sell naked puts as long as your account can take the assignment of them. And at that point, then they go up in value or they go to zero. So that's the worst can happen. So in answer to your question, there's about 10 or 15. I'm not going to do it tonight by any means. There's about 10 to 15 different option trading strategies. I want to teach you guys a bunch of them. Okay. The one that you will probably like, based on what you just asked, is called an iron condor. Okay. What it is you go out way far on the put side, away from the money. You look at the probability, and you say, okay, this thing's got a 12% probability of being in the money. Okay. And then you go all the way to the call side, and you find one that has 12% probability of being in the money. And you can say, okay, I'm going to sell that put, and I'm going to sell that call, because both of them are collecting you premium, and both of them are so far out of the money. However,
you just want price to stay in the range.
Right. Here's where you get yourself in trouble. A big movement in that underlying stock can get you in trouble. Okay? Because you may collect 20 cents on that thing. All of a sudden the stock drops a bunch, and now that premium's at $1.80. Okay? And you're like, dang, I sold the 20 cent on the put side. I sold the call side for 15 cents, so I collected 35 cents, but I got one side that's going against me $1.80 right now. So what do I do here? Well, you would obviously have to buy that back and take the loss. So that's where I told you on the naked side of trading, all your risk is defined in options 100% through option trading tier levels of 1, 2, and 3. However, on the naked side, you can get yourself in trouble. Why? It's a little harder to get approved for it. You kind of got to prove yourself that you don't get in trouble. But there's a trading strategy called an iron condor. I'm sure most of you guys have heard the word at least. I can show you what an iron condor is. It's the exact same thing as what we just talked about. However, rather than just sell a naked call and sell a naked put, you buy an option also. And that's where it creates what's called a spread, and it also caps the risk off. So if you had, on this particular one, say you sold the puts 15 and you collected 20 cents, okay, and you did it naked, you're like, the thing's not going to drop to 15 cents or $15. I collected on NEGG. I collected 15 cents or 20 cents, whatever. You still have a risk there, an air risk that this thing could go to $12 on some crappy news, and now all of a sudden your ones that you sold for 20 cents are worth $3. And you're like, all right, so I collected $20 each contract. I did 10 contracts, and now they're worth $300. So my $200 that I collected is now going against me by $3,000. What you do is, I'm not going to teach it tonight, you create a credit spread using a iron condor to where you cap off the loss. So if you sold a 15, you might sell a 12. Okay? I mean, buy a 12. So you sold a 15 strike, but rather than sell it naked, you buy a 12. That then caps your loss to $3. The difference between the one you sold at 15 and the one you bought at 12, which is $3. So you don't have an unlimited risk and you're not doing it naked anymore, you're capping off the risk. But all of this stuff you can calculate. You can say, okay, I like Scott's idea, or Scott, motocross, my name is Scott, by the way. Motocross's idea about doing the iron condors. I look at the stock, I get myself, in the 10% range where it has a 10% chance of being successful. There's a chick that, gosh, what's her name? The Karen chick. This is what she did for years and made millions of dollars. Tom, what's his name? Sosnock or something. The guy that started Thinkorswim. I don't remember what it was, Tom something. But he always talks about this Karen lady. The Karen lady, this is what she did and made herself millions of dollars. But, for every 9 trades that work, you get the one that don't work and it eats the 9 up quick. So you got to know what you're doing. You got to be careful. But, when she was out there playing in the 10% range, saying, okay, I'll sell this stuff in the 10% range because it just doesn't get there. When she was doing that, it didn't. But now things have changed a little bit. Markets have changed. They can make big radical moves. So, when you're out there and you look at it and you say, dang, this thing was at 10% yesterday. Now it's got a 60% probability of being in the money. How the heck that happened? So if you created an iron condor where you sold one strike and bought one strike on the put side and then sold one strike and bought one strike on the call side, now you've created a risk-defined trade. You can say, all right, so it's got $3 on the one and $3 on the other. That's the most I can lose. You've now moved to your tier 3 trading to where I told you it's always risk-defined. So by creating the iron condor, now you still get to go way on out there and collect some money, but you define the risk or the worst thing that could go against you. You have that set in stone. It's $3. So that's one of the trades. There's a ton of things I can teach y'all on different trades. Some of them you guys will love. They are so fun to do. I wish I had talked so much tonight because I'd love to show you a butterfly trade I put on. Maybe I'll do it tomorrow in the room. But I think I've probably overdone my stay. I'm an hour and 41 minutes into this. But I put on a butterfly today. I hadn't done one of those in so long, but it was fun. I did it on, what is the name of the stock I did it on real quick? I did it on, hang on, I got to go into this other account. PINS. I can tell you what you guys had enough? I can show you what I did if you want to know.
No, I want to see it.
Yeah, show us, man.
Okay, so what I did, if I'm wearing you out, hopefully you guys are learning something. Probably didn't take you long to figure out I got a little bit of options knowledge. I find that stupid thing here, pins. Okay, so if you look at the chart, let me pull up the chart on that thing. PINS. PINS. All right, here's the chart on it. All right, that's Pinterest. It got smacked down. Their user numbers went down and blah, 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 and all kinds of good stuff that wasn't so good. And they got smacked down to the $60 range, okay? And they came there from $78. So that's a pretty big smackdown. All right, so I looked at that and I thought, okay, is it overdone? It's had a couple of days that went back up. 3 days. One day it went up really nice. Yesterday was an indecisive day. They couldn't quite decide if they wanted to go take it up or take it down. Night, Amber. Thanks for coming. And then today they went back up again. So I thought, okay, this thing's got a pretty decent chance of going up. So I'm going to play that. So here's what I did. I got it on my trading platform. Remember which one I did. I did an August 20 expiration. Okay, so I'm gonna click on pins. Here, I'll build this thing for y'all. I'll build it. There's so many things I gotta teach y'all. There's pinch plays. I've done many classes on Thinkorswim on how to use this thing. All right, a butterfly. Oh, here's the one I did. I forgot I set it up before I left, or before I started this. Okay, what a butterfly is, you can do a call butterfly or you can do a put butterfly, okay? And what it is you buy one in the money contract, call contract, you sell 2 at the money call contracts, and you buy one out of the money call contract, okay? So in this particular case, here's what can happen, okay? I went with an August 20 expiration. That's 15 days from now. And looking at that chart, I thought, okay, it started at $78 and it dropped down to less than $60. So I want to start at the $60 where it seems to have found a little bit of positive, reaction from the traders. It went up one day, then it was a spinning top candle, doji candle yesterday. So indecisive. Do we want to go up? Do we want to go down? Today it went back up again. I thought, okay, I'll give myself a little bit of time. So I went with an August 20, 15 days from now. That's my expiration. And I went right about where, let me see if it was a particular moving average. No, I went right in the middle. It showed the 100-day and the 50-day. Right at, I'll put that chart back up again. It showed the 100-day, which is the red line here, and the blue days, the blue one's a 50-day, right at $70, and it traded right at $60. Okay, that's where it closed today, right around 60, and it dropped from that 70 range. So I thought, let's go with the middle of that. Let's just say they get halfway there, keep running this thing up. I got 15 days for it to happen. They keep running it up, and they get to about $65, and some of the interest falls out again. So here's the trade that I put on. It's called a butterfly. Okay, what I did is I bought a $60 call. Okay, I bought one. I'm going to use one to make it simple. I actually did more than that. I bought a $60 call. Okay, so that's a call I own. You got to be a tier 3 to make this trade. I sold 2 of the 65 strike calls. Okay, so that one's $5 out of the money. But that's where I'm wanting it to pin. Okay, when I say pin, that's the general area where I want that thing to be in 15 days. And I think that gives it adequate time for it to get there. So these are inexpensive plays to take. And they either work or they don't. Okay, and then I bought a 60 strike call. I sold 2 65 calls, and I bought a 70 call. All right, so here's what happens. If you look through this column I'm circling, it's $1.16 debit. Okay, so that cost me $1.16 or $116 per contract. All right, so that is my risk. That is the most I can lose is $1.16 or $116 per contract. Okay, now I could tell you the answers here, or I could quiz y'all and see if you guys are paying attention. Okay, so right here we're trading at $60.33. All right, so $60. I'll tell you. I'll make it easy on y'all. Okay, the 65 strike call is where I want it to pin. Both of those have no intrinsic value because they're out of the money, so they're of zero value. Okay. The 70 strike call is even worse. The other one I bought. It has no intrinsic value. Okay? It's a 70 strike call. We're trading at $60. It's $10 away from having any value whatsoever. That's okay. Now the 60 strike call that I bought, if you look right here, the 60 is actually at the money. So it's in the money by 33 cents. So theoretically, as it stands right now, what I paid $1.16 for, I actually filled for $1.16, so it ended up the day right at what I filled. What I paid $1.16 for has 33 cents because we're at $60.33 on the stock price, and I bought a $60 call, so it has 33 cents of intrinsic value or true value, which means I have 67, 77, I have 83 cents of extrinsic value or no value. Okay, y'all with me so far? Did I lose you? You still follow me? Okay. What I want to happen is I want that thing to pin that 65 strike or close. Okay? So if it gets to half the movement back of what it gave up over the last few days, went from 70 down to 60, and if it gets back to $65 and it pins there, I have 15 days for it to happen. Now, it doesn't have to pin there exactly. Let's say theoretically it does. Let's say it pins at $65. Okay, just to make it simple. My 60 calls are now worth $5 because there's 60 calls and it's trading at 65. So now that would be, I could close that out and I'd have $500 per contract, and my risk was $1.16. Okay, so I risked per contract $116 to make $500 if I'm right. Okay, if it pins right around 65 bucks, then the two contracts that I sold, the two call contracts that I sold at 65 bucks will basically be worthless. Okay, the 70 strike that I sold is also going to be worthless. So in this butterfly trade with a 60 call bought and 265 sold and a 70 call bought at $65, my 60 bought call is the only thing of any value in this trade. Everything else went worthless. Y'all follow me there? So it's worth $5.
But wouldn't the ideal price then be like 64? So then you get the premium on the calls that you sold at 65, and then also get the
Right. Well, if it
reward from the 60.
if it closed at 64, if it closed at 60, see the range for me to make money on this thing is between 60 and 65 bucks, but I can also make it on the upside between 65 and 70. Okay, so if the only way this trade would lose my defined risk of $1.16 or $116 per contract is if that thing closes in 15 days below 60 or above 70. Okay, so
Right.
given myself a $10 range to make money on that stock, and I've got 15 days for it to happen. So my risk reward is pretty good on it because my reward at a 65 pin is $500 on a $116 investment. In your case, where you just asked about 64, that would be great because my reward at 64 is the 265s that were sold are worthless. The 70 that I bought is worthless, but it's worth my 60 call that I own is worth $4. So my $116 investment went up 350%. It's now worth $400 when I close this trade. Okay? There's a few things out there that you can do this with that you don't even have to close them. I don't want to go into that tonight. I'll show you that another night. They're cash secured trades. These, if you think about it, if this closes at $64 in 15 days on that expiration, I actually have to close the trade if I don't want to get the calls assigned to me. Because remember, I got $60 strike price. If it trades at $64, they're $4 in the money. And everything else on the trade is now out of the money. The sold ones at 65 are worthless. The 70 is worthless. But I still now have a 60 call that's $4 in the money. And if I don't want to get shares assigned to me at 60 bucks, I have to close this option trade. You follow what I'm saying there? I sold my buy port was 60 bucks. It's at 64 at expiration day. I have to close that, or I'll get the shares assigned to me because I'm $4 in the money on the low buy on my butterfly. Does that make sense?
So when you do these spreads, you can't let them expire. You have to essentially cash them out for the expiration.
About 70% of the time you do. Okay?
Okay.
I'm going to show you some other spreads where if they go in the money and you have a call that is in the money, but you also have a sold option that is in the money, if both of them are in the money, your broker will wash it. So you don't have to pay the commission to close the trade. Okay, I'll show you some of those on another class. There's some that you can trade. This isn't one of them. If this one closes in the money on either above 60 or below 70, you will have to close this trade. What you don't have to do is the commission's a little higher on a four-legged trade like this, where you buy a 60, sell two 65s, and buy a 70. That's called a four-legged trade. You're paying commission on each one of those legs just like you would anything else. However, if you get to the point where this thing closes at 64, you only have one of the legs you have to close because the other three went worthless. It's a little tricky game to play, and you got to be careful. Unless you have a decent size account, your broker's going to close that thing for you to keep you from getting yourself in trouble. Or, in my case, I can play with it right to the end of the trading day and say, hey, I think this thing's not going to go above 65 anymore, so I'm just going to close the 60 leg. And if it happens to go above 65, my account can handle it. It's not what you want to happen, but a lot of your brokers are going to close that trade for you. But you're not.
Yeah, TOS will force close them and
they'll
give you
force
the
close
shares.
But keep in mind,
Yep.
you're not playing this trade to the end of the trade for expiration. That's when you become a greedy trader, okay? How many trades do you guys make in a day where you're messing with these penny stocks and you do 500 shares of XYZ company, you got $8,000 tied up in the thing, it moves 10 cents and you're like, wow, man, just made $50. It's awesome. Okay? You made $50 on $8,000 you had tied up. Think about this trade right here that I just showed you. You're in for $1.16. If this thing goes and it's at $60.33, let's say this stock PINS goes to $62 tomorrow. Okay? Well, my $60 one is going to be in the money $2. However, it will be offset by the sold ones. Okay? But keep in mind, those sold ones are going to be starting to have the theta. Tomorrow, the theta is going to get decayed out of everything. Remember I taught you guys about theta? The theta is going to come off on all this stuff, on the 60s, the 65s, and 70s. So everybody's going to lose a little bit there. However, if it went up $2, the call strikes are going to, on the if you own the calls on the 65s, you're going to see some losses in there because of the theta and stuff, but you're going to see a little bit of increase. But because my 60 is so deeper or much deeper in the money, it's going to see a better increase because the delta is going to be much higher. So these are the $2 move. Just throwing a number out, could go from $1.16 to say $1.90. Okay, so now you got a trade that you invested $116 in. It's worth $190. So I put $116 out there, and it's worth $190, which is what, a 40% increase. You guys. So I increased my $116 trade by $70, $74. So I made $74 on this garbage little butterfly trade, and you guys made $50 putting $8,000 into OCGA or H, whatever it was. You see the difference? I got $116 on the line. And if this thing goes to 63, if it goes to 65 and pins even close to it, it's going to need $500 for me. So for every contract, my $500 made me $384. That's a 300% increase. You guys would be dying to make 300% increases in 15 days on the amount of capital you're putting out. I mean, look at all these day trades you guys make. And I'm not dissing y'all because I do the same thing y'all do just because I like to day trade. So I get in these trades. I play around with it too. But I got a whole lot of this other stuff going on the side. So as you can see, this butterfly, just one contract, $116 at risk. If that's the most I can lose, so what? Do however many contracts you're comfortable with losing. There's better plays out there. I just did this one because I feel like that stock got overpunished just because their membership numbers, subscription numbers went down. I feel like they were overpunished. For that reason, I thought, this thing might do a dead cat bounce, get half that back. So I was willing to risk $116 a contract just to try it. But do you get where my risk reward is really good here?
Yeah, it's awesome.
Oh yeah,
So-
it's like 4 times. Yeah.
So what sort of special permissions do you need? You said like level 3 or whatever options permissions in order to sell call.
Yeah, you've got to have of the 4 tiers. You obviously probably came here late, so you didn't get to hear the first part, which I went over all of that. And again, I'm recording this thing, so I'll put it in the room. If you listen to the beginning part, there's 4 tiers. You got to be the tier 3. You've got to be able to buy options and sell options. But there's this little butterfly trade I just showed you there. One of my favorite things to do is, and I'm not going to show you, I promise. I'm not going to talk all that much longer. It's called, I could, but I won't. It's called an iron butterfly. It's where you do 2 at the monies, where you sell 2 at the money, but you do 1 on the put side and 1 on the call side. So you're selling at the money on the call side, selling at the money on the put side, and then you buy one way out on the call side, and you buy one way low on the put side, and then you try to get it to pin at your strike. And those pay some good money for the amount of risk you put in it. It's stupid. It's crazy. You do them on SPX and stuff like that. You can risk. You can get one that you collect. On a 50-point spread, you can get $4,300 credit, and if it pins, you keep that $4,300 if you're close. You've got a 50-point spread on there, so in other words, you're doing at the money what the SPX is trading at 44.29 right now. It's called an iron butterfly. I'll teach you all that on another night, where you sell a call, sell a put at the money at the 44.30, and then you go out 50 points, 100 points, whatever you're comfortable with. And I can show you, how that works. But when those things pin, I've had them pin. You got $4,300 credit, and you did one contract. And that, and the worst can happen because you're out 50 points is you can lose $5,000, but you collected 4,300. So your risk is 700. But if you pin that thing or get really close to pinning that thing, the 4,300 credit you collected, you keep. So you can be wrong
Damn.
5-6 more times before you get bit if you keep your risk reward ratio always in check. If you always say this, when I got some other trades I'll show you. I got a certain amount that I'm only willing to spend because the most I'm willing to lose, and I mean it's as concrete as most everything else in my life. I won't stray from it. And on those trades, if you get one to pin for $4,000 or $5,000 and your risk was 700, you don't have to play them that way. They came out with another one that trades exactly like SPX but 1/10. So in that case, your risk would be $70 against $500. But when you guys start getting a taste of these trades and say, geez, I risked $70 and I just pulled one out of my ass for $500. Well, that's the first time I cussed. I try not to do that on these videos. I just pulled $500 out of that thing. Now you can do it 6, 7, 8 more times.
Cage.
Do what? Yeah. Do what?
I think he's doing something else.
Oh, he's
Yeah, I was letting my
talking
dog hang
to
on.
his kid, probably. I'm assuming your kid's name's Cage. All right, but you see the risk reward is really good. It's good. I got 116 bucks on that one at risk. And then some of you other guys that have larger capital, there's some other things I can get you in where, I explained one last week. I had about 4 more of those this week where your risk is defined and it's minimal and your reward is unlimited to the upside. I can set you guys up in positions. It ties up capital, but if you got lots of capital, you don't care. I can get you in a bunch of different trades where your risk is defined, but it's set. The parameters are set on it, and then your reward is unlimited. If a stock goes up and up and up, and if you get yourself hung on one of these that happens to be one of these plays that the Wall Street Bets crew gets a hold of, or Reddit and all that, it's golden. You're in one of these trades that you got a defined risk, and because you bought puts on it, and you've got an unlimited upside, and you get one of these, they hang on, and you go with it. So there's a ton of stuff.
Yeah, that's one of the other cool things too. Like GameStop, you couldn't short on TOS, but if you knew what you're doing, you could do the puts for it and pretty much do the same thing.
Yeah,
It was pretty neat
you
back
can
in
do
the
all
day.
options and stuff. So
Yep.
All right, I just clicked the 2-hour bell. I think. Where is it? Yeah, 2 hours and 2 minutes. So now I am going to stop. I could go on all night. I love this stuff. I enjoy the company. I taught it for years and it was fun. I just enjoy it. I want people to learn. And tomorrow in the room, I'd love if somebody said, I looked at the option on this thing, and there's 18,000 or 22,000 contracts on such and such stock on the put side. So my guess is they're probably not going to run that thing down there because they don't want those to go in the money. Because the market makers will lose if
love
those
that.
go in the money. One of you guys is going to say, hey, Moto, I found this stock on XYZ or Space, SPC. And I did the math. It's 29,000 contracts times 100 times in the money $4 is $8 million. There's no way they're going to close SPCE with $8 million or $18 million worth of options in the money. And I want you guys to pick up on that stuff because it will influence how you day trade this other stuff. You can look at that kind of stuff. It requires a little more homework, but you can look at it and say, there is no way they will run this thing to, in Space's case, to $32. You can tell yourself there's just too much money. It will cost the market makers to go to $32 with the stock, so it ain't happening. And it wasn't that long ago. It was bank. You could bank on it. It was an ATM machine. I mean, I did it for a few years with a room, and we just banked big time on it. I mean, because there wasn't enough stock volume to offset the options volume, and they would run these stocks to a certain area to get the stuff out of the money, and it worked like clockwork on a Friday. I mean, you could watch it, and you could. It was almost scary. You could tell them where that damn stock was going to close, and if you had the stock pinning sites open, you could tell them exactly where it was going to close. But they got smart to that crap, and now the volume's too high on stocks. But it will still, you guys will still benefit from it, where you can look at stuff and say, there is no way they will run that stock and let that much call option or that much put option go in the money. It's just not going to happen.
Yeah, like that. Like if AMD happens to approach 115 at all
Let me look.
tomorrow.
Let me pull it up again. Hang on.
Yeah, 115's got a 57,000.
Yeah, anything above 115, hammer it.
You guys got the
Hammer
tomorrow,
it short.
tomorrow expiration open. Let's see, AMD.
Yeah, tomorrow expiration.
Or
Yeah,
the trade.
115.
Let's see, tomorrow's expiration on the 115. Let me stretch that back out again. On the 115 strike, yeah, there's we don't know what that is yet though. That's 57,146 in volume. Now keep in mind, jot that down and then, or screenshot it, and then jot down the 21,456 in open interest. And you can take that particular. I'm good. You can take that particular strike, but look at the one under it. Okay, that one has 36,173 volume and 13,000. Now go back down even 5 steps further down from that. Look at the 109. Is it 109? 110. Okay. Look at the 110 and say, okay, there's 16,000 open interest. I want to see how much of that 10,900 volume goes into that one. So you can look at what goes in there, and then you can look at what goes in on that 115 strike, what goes in on the 116 strike, and then you can go up higher to the next one, 24,000, and see what sticks on the open interest tomorrow. And if those are big numbers and they're huge numbers, then you can tell yourself there's no way they'll run this thing to 115 and let all that close in the money. But you got to do your homework. You got to flip over to the other side also. Because if they go to 115 on the other side, here's where it's real important. You guys look at this. And it used to be influential 100%. It's not anymore. But look at this thing on the put side, okay? If they went to 115, they would negate that 31,884 volume on the put side. They would also negate the 20,000 and the 21,500 on the 14s and 13s. Okay? All of those would go out of the money. You see what I'm saying?
Mm-hmm.
But that's the point where they need to stop on the call side. Because if they go any further to 115, they're going to let that 57,000, depending on what it does tomorrow in open interest, come into the money. So if they were to, based on what we see tonight, based on what we're looking at, it's hard to gauge because it's a lot of volume on the call side, and we don't know where it's going. But tomorrow morning it'll be a little easier. We can look at that and say, okay, a lot of that stuff went into the open interest. Obviously, it's a lot because if there's 39,000 contracts traded on that particular one I'm circling, there's only 6,500 open interest. A lot of that's got to hang around somewhere in there. So that number is going to go up considerably. But you can look at it and say, okay, there's no way they'll run that above 115 if a bunch of that moves from the volume column into the open interest. You go over to the other side and you say there's no way they want to keep this thing at 112.35 and let all this volume, if it turns into open interest, can you guys still see me circling it? If a bunch of that volume turns into open interest, then it stays in the money if they keep this thing at 112. So they don't want that to stay in the money. So you can look at that and say, okay, tomorrow morning you say, okay, a ton of that stuff on the put side went over into the open interest, which means those are now on the table and they stayed on the table. So at 112, these 115s, if that 31,000 and that 73.95 changes to 29,000, then you can say, okay, that 115 strike with 29,000 of open interest, they're not going to want to keep that in the money. So they're going to move that stock up to 115 or close to it. But they're probably not going to go above it based on what happens to the 57,000 over here. If that 57,000 goes on over into the 21 side, to the 21,000 volume, they're not going to want to go above it. So can you guys see where the happy medium's falling on this thing? They're not going to want to go, depending on what happens tomorrow with all this volume. There's a ton of volume today. They're not going to want to go above 115 if that stuff moves over. And they're not going to want to keep it at 112 if the put side stuff moves over, because that stays in the money. So there's a 115, 112 range in there where they're going to find that happy medium, and there's sites out there that can tell you exactly where the best pin is, and you can watch how it works out. But you want to look at the volume tomorrow, and you want to understand, the open interest. You want to look at the open interest and understand what happened, where that volume moved in. Look at all those numbers we're just looking at and circling there, and say, I want to screenshot this, and I want to look at it tomorrow. If a ton of
I screenshot it too.
If a ton of that stuff goes into the open interest column on the put side and the call side, you're going to say, okay, based on that, I can do the math that these 115s, That 112 put trading price, a 115 put is $3 in the money. So if they're say that 31,000, most of it moves over, and that 7,000 on this side becomes 30,000. You're going to go, okay, so 30,000 times 100 times $3 in the money is X millions of dollars. They're not going to want to keep that in there. Okay? I'll be honest with you, in this particular stock, these numbers are not going to make much influence on a stock that's trading 137 million shares. Because the reality is, that's a lot of shares trading. $112 and 137 million shares. Hang on one second. Okay, back. All right, so but you can find stocks that have huge interest, open interest like this. There's websites that there's guys in there. I don't remember the guy's name. There's a couple. There's a guy on TV named John and Pete Nigerian brothers. That's what they do for that news station. It's the Channel 43 on Spectrum. It's about the investments in stocks and stuff. They find the open interest or volume imbalances is what it's called. They give those to the viewers and stuff. They front load it. They get the stuff in first, and then they say, okay, guys, here's a huge move on this one. I actually wrote a couple of scanners in this Thinkorswim that'll find them for me. I can get it to populate in real time in a market watch. I can set a market watch, get it to populate in real time, and as an open interest, a volume imbalance comes in, those stocks will pop up for me. But that's what you want to look at. And then you want to look at the volume of the stocks, and that stock's trading an awful lot. But there's a lot of stocks out there that don't have that kind of volume, but have that kind of volume and open interest in the options. Are we still on the same page? Or did I lose y'all?
Yeah, this is awesome.
Y'all
Yeah, I agree.
I've been begging y'all to let me do this. I love doing this stuff. I like people to learn. I enjoy doing it. And I didn't do it for a while, so it makes me a little rusty. When you do this stuff week after week after week for years like I did, you're pretty polished. I'd consider myself kind of rusty. I'm kind of
You
winging.
did a good job.
Some of this stuff I'm
I
winging
appreciate it.
only because I haven't done it.
You did okay. I taught Mitch way better than you did this morning, though.
I figured
But,
you
you
probably
did all
did.
right.
You guys get up earlier than this. I bet you I can get two, or if this was recorded, I bet you I can get a couple more guys in the next Thursdays. You're gonna be like, hey man, we gotta
Probably no, it's good.
we gotta learn some more of this stuff. Well, let me do this.
Yes,
Huh?
So all I ever did, I would just like Pfizer's my biggest win. I bought Pfizer strike for like 32 or whatever, and it got to 39. I sold it, and I made like $2,000. It was like a $200
Oh yeah.
premium. That's the best one I've ever done. But I just do for the strikes. I've never done any your butterflies or anything crazy like that.
Right. Let me look at it here. There's Pfizer. I keep them on mine. So I think they're a little stretched here. $45. But for you guys, if Jerry's still around, if he's still around, for you guys that say you get approved for tier 2, and all you can do right now is buy an option, you can't actually sell one. We don't want to do them for tomorrow, obviously, because those are going to expire. But let's look at next week expiration, 8 days. So it's trading at $45. A 45 call is 60 cents. Okay, so if you wanted to dip your feet in the water a little bit, you could say, okay, I'm willing to risk $55. It's trading at $45.06. Okay, I'm gonna test y'all here. Okay, do you guys see where the 59 and 60 cents is that I'm circling? Can you see that?
Yeah.
Okay.
Yeah.
That's a 45 strike call. You could fill that at 60 cents. Okay. Now it's quiz time. How much intrinsic value does that call have? Intrinsic value. Damn, don't you hate being put on the spot? Especially when you're first day in kindergarten. Hey man, we're kindergartners with this options crap. This is our first day. You're already giving us a quiz. Okay, so you're on a 45 strike. You have a 60 cents.
You'd be
60 cents. You have a 60-cent premium. A portion of that is intrinsic value, and a portion of that is extrinsic value, which is the time decay or the worthless part.
right.
Okay, so I'll see. I'm not
I
getting.
mean, it's in that one's in the money on 6 cents
There
already.
you go. Very good. It's in the money
That'd be
by
your
6 cents.
intrinsic,
So
yeah.
your intrinsic value is 6 cents, and your extrinsic value is 54 cents.
Yeah.
So, however, but look at this. Now, it's not likely that Pfizer moves a buck because it doesn't move like that. But if you look at that option, it expires next Friday, 8 days from now. For 60 cents, you could fill one contract. If it moves $1, okay, let's just say it moves $1. Let's say COVID just runs rampant and Pfizer comes out and says, hey guys, we've been anticipating this and we're miles ahead of you, Johnson & Johnson. Here's a new vaccine. Boom, and this thing goes up $1. Look at the delta. What's the delta on this thing?
Yeah, you'd be worth $1.16 then.
Right, you would almost double your money on a dollar move.
Yep.
So if you guys said, hey, with all this COVID crap going on, I'm going to take a $60 risk on Pfizer. And I'm going to buy one of these 45 calls for next week and see what happens. Worst case, if it goes up $1, okay, look at your theta. Your theta is 3 cents. So 3 cents is going to tick away on that thing for 7 days. So you're going to lose 3 cents off it. But if it goes up $1, these are at the monies. So it's not like you're going to 50 over here. I'll circle it. Here's where the mistakes come in. If you look at the numbers here, the volume numbers and stuff, here's where the mistakes come in. Here's where the newbies, traders come in. They say, with all this COVID going on, the right news could make Pfizer go to whatever. And a $50 strike is only 3 cents or 4 cents on a midfield. So for $4, I can do 10 contracts. For 10 contracts, I got $40 in it plus commission. And for 10 contracts, I can, the first dollar, if you look over here to the delta, it's 4 cents. They can double their money also. Okay? And you're thinking, okay, so I got 10 contracts now. That stupid thing goes up $1. Well, it's still only got a 4 cent delta. So if it goes up $1, yeah, they doubled their money also, but they paid a lot more in commissions for 10 contracts. And if you look at all this volume and crap going on over here, it's because it looks attractive because it's cheap. They can do one contract for $4. And in the unlikely event some major thing happens with Pfizer and that thing goes up $4, which it isn't going to, they're going to hit the ball out of the park. You see what I'm saying? That's what these newbies are doing. They're like, yeah, I can play Pfizer for $5. But you guys who now have some knowledge can tell me by looking at the August 13 expiration why probably won't go above $47. So all those guys in the $50 range are missing it. Why wouldn't it go above $47?
Because you give
There's so much open
11,000.
interest. Yeah, the market makers would lose all that money from the
Right.
open interest on the lower calls.
Yep.
Right. The open interest on the 40s, I can't see the line across, but on the 47s, on the 47, if 11,000 volume, if a bunch of that goes into that 8,000 open interest, say that's sitting at 18,000 miles, they're not going to want to go above $47. It's not going to happen. So if nothing else, I know you guys are seeing stuff you didn't see before.
Yeah, I've learned a lot just from today.
What I want to find is all the outlier strikes. I've seen a bunch where they'll be $1, and then that random strike that'll be 20 cents.
There's a lot of that.
Those are the really good. Yeah, they're really good ones to buy. But how do you find them without just typing in 1,000 tickers and getting lucky?
I can write a scanner. I don't know how familiar you guys are with Thinkorswim. I actually taught a bunch of classes on it. But I can write some scanners, and I've got probably 50 or 60. I'll look through them and see if one will already identify it, or if I can make one, tweak it just a little bit to where it will. We can get one to find that stuff. I know I got one that says open interest imbalances. It'll scan for that, and if you run a scanner in MarketWatch, it'll scan it in real time to where as a ticker comes into the parameters that you've set, it shows that as it populates them during the day. as stuff comes into the criteria that you defined, it will populate them in that market watch for you. And the minute it
Yeah.
populates, you can click on that thing. And if you got your option chain open, you can say, oh, there's why that thing came in right there, because there's 4,500 contracts just went off on the put side of that thing. And then you kind of look at it, you look around it, you see what's going on around it, and try to make an educated guess as to why. Let me show you one other thing on here also real quick. I'll never shut up. Y'all are bad influence. Okay, option time and sales. Here's what I want you to see. If you go down to option time and sales, let me do this. Let me can the. I'm gonna kill the recording on this thing. Okay, guys, because I don't know how long it'll let you go. If I kill that, then hang on.